Hi everyone. I wanted to take a few minutes to give you a kind of a high level view of the course and what we talked about and why we talked about it and all of the connections between those things. So we're going to call this our course wrap up. And we started out with a discussion of market efficiency. So this was, again, the idea that information that is relevant for the pricing of financial assets is contained within that price or incorporated into that price from the moment that information is made public. And we talked about three different versions of this idea. One was weak form efficiency, where the information that's immediately and correctly incorporated into prices is based on past prices. And then we talked about semi-strong form efficiency, which the information that is immediately incorporated into prices with that is all public information. And then lastly was strong form market efficiency, which is that private and public information is incorporated into prices. So if I could spell here, there we go. So this was the beginning. We discussed the definition of market efficiency. And the reason we spend all that time on this is that this is, or at least has been in the last 50, 60 years, the paradigm that most people had for how markets worked. There was some version of efficiency. Most people sort of, at least in the academic sphere and to a large extent in the practice of finance as well, viewed markets as being at least broadly efficient. No one really thought strong form efficiency was the form that this took, but for the most part, semi-strong or at least weak form efficiency was to an extent taken for granted. So that was where we began. Again, where the starting point was the paradigm of certainly academia and, like I said, much of industry as well. Until 20 or 30 years ago, sort of cracks in that paradigm started appearing. And then from there, we went and talked about counterexamples to efficiency. And this was things like bubbles and various predictable price movements observed in actual asset prices, things like momentum or post-earnings announcement drift, etc., that seem to be counter to this idea of market efficiency. And so we were just trying to say with this, hey, look, here are some things that don't fit into this market efficiency paradigm. And we talked about, what the assumptions are or what conditions are required for markets to be efficient. One of those, or one version of those, is that everyone that participates in the market is rational. And, I think I made the argument at the time that casual observation of one's own behavior should reveal not everyone is rational, at least for most of us. But we went through some evidence eventually arguing, look, people are not rational. So this is all of the investor behavior and biases information that we covered. So arguing that market participants are not rational. At one point, we also said, well, that's okay. This is one way for markets to be efficient, but there's another set of conditions under which we would expect markets to be efficient, and that is that there is sort of random irrationality. Sorry, spelling while talking is hard for me. Random irrationality among market participants. And the idea here is that these random mistakes caused by the random irrationality sort of cancel each other out. So the mistakes that some people make are to overvalue assets, and the mistakes that other people make are to undervalue assets, and that those two effects, since they are random, they should apply sort of equally to the overvaluation and the undervaluation, and those mistakes cancel out. And the evidence against this was also part of the investor behavior, where we showed not only do people make mistakes, but they seem to make similar mistakes, if not everyone, then at least on average. So this idea of investor behavior and biases sort of precluding the possibility of everyone being rational, and also of any irrationality being random, is what that was all about. And we also said, finally, the third set of circumstances under which we would expect market efficiency is correlated irrationality. So this is the idea that we discussed, that people seem to make similar mistakes. And that's okay. We can still have efficient markets as long as there is unlimited arbitrage as well. So meaning there are at least some very powerful, well-financed market participants. The classic sort of example in people's mind of this is a hedge fund that understand this irrationality and trade against it in an effort to capture potential arbitrage profit. So this is where we then said, okay, that's great. In theory, that would work, except there are limits to arbitrage that actually preclude even a well-informed, rational investor from actually trading against any irrational, systematic mispricing. So in some cases, that was residual risk. That was the idea that, unless you can guarantee that your trade will immediately eliminate the pricing mistake, that pricing mistake could get worse, and that would be bad for you as the arbitrageur. So it ranged from that to, in some circumstances, the rational, well-financed hedge fund type investor wouldn't even want to trade against the irrationality. They might want to trade with it, at least for a while. So there's an incentive issue here with these theoretical institutions or market participants, whereby they wouldn't actually want to sort of engage in the arbitrage that theory would suggest they should. So we've got these three conditions in which markets we would expect to be efficient, and then we've got sort of arguments refuting that this is in fact what we see. We don't see these conditions met in real life, and therefore it's very reasonable to expect markets to be inefficient in practice. So that's sort of the main conceptual point of the course, is that, trying to convey this idea of efficiency, when we would expect efficiency to exist, and showing you, hopefully convincing you, that at least to some extent those conditions aren't met, and therefore markets may not be efficient. I think there is a tendency at that point for people to think, oh, well, I should go out there and try to capture all these inefficient prices and generate really high returns, etc. And there's nothing wrong with that to an extent. But I think we need to think carefully about sort of, what do we do with this information? What are the implications of this? And while for a little while one might capture abnormal returns, it is impossible to outperform the market in the long run, because if you were systematically outperforming the market, eventually you would be bigger than the market, which is clearly not possible. So, in the shorter term, sure, maybe you can identify some inefficiencies. But in the long run, that's not going to play out without exception over decades and decades. I think the bigger concern, the more the thing we should think about more, is how this applies honestly to capital budgeting. So I always say capital budgeting is the single most important thing we do, or at least finance professionals do, And that is because capital budgeting is the actual creation of wealth. So when we trade stocks, we're assigning wealth to different individuals, and that's well and good. But capital budgeting, identifying positive NPV projects, is the actual act of creating that wealth that other financial assets then assign ownership to. So since we use prices when identifying positive NPV projects, and just for the chain of logic here, we value potential projects using a cost of capital, often the weighted average cost of capital. That weighted average cost of capital is the result of identifying expected returns. And we often, in fact, almost exclusively estimate expected returns using prices. So when we are doing capital budgeting, when we're identifying profitable projects, we are implicitly using observed prices for that valuation. If those prices are wrong or inefficient, then the question remains, are we making good financial decisions? I'm not saying we aren't on average. I'm just saying that this is the biggest concern, at least in my mind, for this idea of markets being inefficient. We're using these prices to value other opportunities. If those prices are wrong, then we're potentially making mistakes, and rather than creating wealth, we're destroying wealth. And there's no easy answer to what do we do with this, but I think it's worth always having in the back of your mind, since many of you that do go on and become finance professionals will be at least at some point using a cost of capital for valuation, to think, are the prices I'm basing this on reasonable? Do I have a good reason to think they're not? That is an important consideration as you go forth from this class and the U more broadly. So hopefully that's given you an idea of how it all connects, sort of the course structure and what I wanted you to take away, and then sort of what are the implications of the course as well with this valuation and using prices for valuation and the potential risks of that. Other than that, I hope you enjoyed the course. If you have not already, please feel free to do your SRTs via the Canvas site. And, I look forward to meeting some or all of you eventually in person.